Bonds?
Bonds, baby. Tell me more about bonds. Everybody wants to know how bonds work. It's exciting. Nobody cares!
So Dope Mike will probably never do bonds, at least not in the near future. There's a reason for this. It's a predictable asset. It's a fixed income asset. They're trying to tell you actually from the get-go what you should expect. And there's nothing exciting about predictability. There's also nothing really exciting about the current yield environment. It's at all-time lows. Interest rates, all-time lows. So why in the world would anyone consider owning bonds given the current environment if they're not exciting and at the same time there isn't a really good yield? So let's cover 5 different reasons why somebody might consider investing in bonds even though they're pretty boring. But before we do that, my name is Michael McKelvey. I'm a certified financial planner. I'm a fiduciary. If you're looking for more financial education like this from somebody in the industry, hit that subscribe button. We'll be posting videos every week. Follow along with us. Let's jump to it. So we'll start with a key question here. When do people typically need to access their monies? Good or bad times? Now the follow-up to this is how do most growth assets, most growth-minded investments perform during bad times? They typically don't do too well. This is the whole foundation for why someone might have bonds as a part of their portfolio. Okay, so a bond is essentially an I.O.U. You give somebody money, in exchange for that, they're going to pay you interest over a set period of time. These interest payments are called coupon payments. And the reason for that actually is because you used to get a paper bond and you'd have coupons. And these coupons you would take into the bank every 6 months and you would get basically cash for it. So it's a little less exciting now. It's all electronic now. The yield environment is also a little less exciting now, but we'll talk about that. Now, if you were to hold this bond to maturity, which most people are buying bond funds now, so this isn't necessarily something you'd be dealing with, but if you were to hold it to maturity, you would get back what's called the par value. You would get what you initially invested back. But that doesn't really happen anymore because somewhere along the line it's typically being traded. If it's a bond fund that you own, which is what most people have, the bond fund manager, how many times can I say bonds in a couple minutes here, would trade it somewhere along the line, and that price would be dependent upon a number of different variables. One of the biggest ones being interest rates. It's easiest to think through this kind of with a teeter-totter actually. So if you have interest rates on one side and you have price of the bonds on the other side, let's say the current interest rate environment gives you a bond at 4%, AAA bond at 4%. That would be nice. And you have the price down here at 1,000. If, let's say, interest rates come down, which is what's been happening over the last decade, they come down to maybe 2%, price invariably needs to go up. So it becomes a premium. Reason for that is the bond that you bought at 4%, that looks pretty good right now. The new bonds, the similar risk level, are only giving you 2%. So your bond is worth more. And this is what we've seen really over the last few decades. But let's say it goes the opposite way. Let's say interest rates are to go up, price would come down because the newly issued bonds would be paying out more interest than the bond that you originally got at 4%. So it's an inverse relationship that determines this price. So loaning money out, that's a little nerve-wracking, right? You're giving someone money with the hopes that someday they're going to pay you back. And obviously there's risk with that. It's called default risk. The company might go under. But this isn't your nephew or your buddy that you're a little worried about spotting because you're like, I don't really know if they're ever really going to pay me back. These are large institutions and governments. And the reason why there's seen to be less risk here than stocks, I would really classify it as a different form of risk too, because there's sometimes inflationary risk, obviously, with bonds. But the reason why there's typically seen as less risk with your original investment is because bondholders or debt holders have obligations over stockholders. So when bankruptcy occurs, if it occurs for a company, debt holders would be paid back first. And this is typically done in what's called a recovery rate. So it's very rare that you would lose your entire investment. You're usually given a percentage of it back when a company declares bankruptcy, which is less than any obligation a company has for stock because they don't have any obligation at all to pay you your money back. So reason number one, you have short-term goals and you maybe don't want to take on a bunch of risk for those goals. Okay, so there's a key difference between stocks and bonds in regards to risk. Stockholders do not have precedence over bondholders when a bankruptcy occurs. So bondholders take precedence over stockholders. They're going to get paid back first when a bankruptcy occurs. There's an obligation for that. There's also an obligation for bondholders to get some form of an interest payment over the course of that bond length's term. There is no such obligation to pay you anything with the stock. It's just whether or not that company appreciates or whether or not that company has enough money to pay out a dividend, right? There's no obligation to give you that though. So when you buy a bond, it's typically seen as less risk primarily for this reason. Now, there's still inflationary risk, there's still default risk, absolutely. But if you look at short-term bond funds, these are very safe bonds. In addition to maybe US Treasuries, a lot of times you can get better rates of return than just putting your money in a savings account. And if you think about doing that over the course of your whole life, it might yield you some significant amount of money for all of those short-term goals you had along the way. Reason number 2, special tax treatment. So municipal bonds as well as treasuries are going to be exempt from federal income taxes. If you actually buy a municipal bond from your own state, you can be exempt from state income taxes as well. So this could be a huge benefit for somebody, especially if they're jumping up into higher brackets. Their risk-adjusted return on a municipal bond could be very attractive given other options. Number 3, bonds have less volatility than stocks. So I can tell you this is especially comforting, especially in a year such as last year where markets are down roughly 30% at one point. Just being able to have conversations with clients and say, hey, you didn't experience this full drop in the market. You have something that, let's say, just in layman's terms, zigged when everything else zagged, right? It's non-correlated. And just from a standpoint of just having less volatility in addition to that, right? So typically bonds aren't going to sway up and down as much as stocks. Now it depends on what kinds of bonds you have. Obviously, if you have high yield or riskier bonds that are yielding more interest, you will have typically more volatility. But if you look historically, bonds are going to swing less than stocks. And we know that we're emotional creatures and we don't always behave rationally. So having less volatility can be a good thing. Number 4, asset preservation. So as we age, we typically add more bonds to our portfolio. There's a reason for this. We actually have a portfolio to preserve. This is our ability to replace our income later in life, right? So it's very valuable to us. There's not a lot of 75-year-olds that are killing at their job. So we eventually do need to replace our income, and that's done a lot of times by building up your nest egg and eventually kicking income off of it. So why would you want to take on more unnecessary risk in the form of maybe having more stocks a part of your portfolio than you really need? You can get the income that you need by maybe having a more conservative portfolio. So this can be a big reason. The other big part of this is what we call sequence risk, right? So sequence risk is essentially the timing of negative events, right? So when you're in the accumulation stage of your life, that is your working years as you're saving up, the timing of negative events, let's say a negative 30% downturn, if that happens earlier in your accumulation years, it doesn't impact things quite as drastically as it would in distribution, right? So if it happened early in your accumulation years versus later, it wouldn't be as big of an impact. You wouldn't see as dramatic of an impact as it would if it happened year 1 in retirement, let's say, versus year 30. The later that it happens in retirement, the better, actually. So sequence risk is another big part of maybe you want more asset preservation in the form of just having more bonds. Number 5, opportunity through rebalancing. So this is something I think is incredibly pertinent to a lot of younger investors. So let's just first really quick, let's think of what a buyer's market is. A buyer's market is the ability to buy when it's a good time to buy. The only way that we get there is it's really by being conservative with our money or having something that's non-correlated. In a lot of ways, bonds hold those two categories in comparison to stocks. Not always, but in a lot of ways they do. So if you think about, let's say 2008, markets dropped 40+%. In that space, as your stock percentage of your portfolio was dropping, you're becoming overweighted with bonds, meaning you're siphoning off more and more to stocks and you're buying in as they drop. And there's quite a bit of data that shows that this can be a pretty quality strategy. It's really a lot of ways that portfolios hopefully are operating during that period of time. If your asset manager or financial advisor or yourself, whoever it is managing it, is actually doing that. But it can be a very, very helpful way to continually keep that portfolio balanced correctly, but also buy in as those drops occur. And the other side of this is maybe you understand a business really well. You're a business owner, or you're just in some area of work where you maybe can identify a good opportunity at a bad time, because that's often when they pop up, is when people don't have the money to go take advantage of them. And you have something that's non-correlated. You say, hey, I can go access this, and now I can jump in. 2011, it'd be nice to be able to buy some properties. The only way you could do that is by having something that was non-correlated. So I think having opportunity through rebalancing is a huge benefit of having at least some percentage in bonds. So a few final very important considerations. You might be unproven as an investor, and you might not know what your real risk tolerance is. And if anything's proven to be true in my experience, in just my practice, it's everybody seems to seek certainty when it comes to short-term liabilities, but they maybe only have long-term aggressive instruments working for them. So it can be counterintuitive a lot of times. The other piece of this is there are absolutely periods of time where bonds outperform stocks, and sometimes long periods of time. Now, given the current yield environment, the current interest rate environment, that is becoming harder seemingly to do. But that doesn't mean we should just abandon debt. It doesn't mean we should just abandon bonds. They're still a very powerful asset for us. And if anything, they're a great way to diversify your portfolio. Now, if you'd like to see some other video on bond alternatives, cash alternatives, drop a comment, drop a question, something you'd like to learn a little bit more about. And if you're enjoying this type of content, feel free to hit the subscribe button and follow along for more of our financial videos.